The first full trading week of 2026 delivered something fascinating. Markets hit record highs on weak jobs data, defense stocks surged 16% on budget proposals, and the S&P 500 now trades at 22 times forward earnings, 18% above its 10-year average. While others celebrate new highs, systematic exploiters recognize what's actually happening here. This is a market operating under two competing psychological forces. The first is momentum comfort. 3 consecutive years of double-digit gains have conditioned participants to expect continuation. When December payrolls delivered only 50,000 jobs against 70,000 expected, markets rallied anyway. This reveals recency bias in its purest form. Recent success creates the assumption that success will persist. The second force is valuation anxiety, though it's being suppressed. Participants know prices are extended, but they're choosing optimism over caution. The rotation from megacap tech into small caps and defense isn't conviction, it's hedging. Apple fell for 7 consecutive days, while nuclear energy stocks jumped 18% on a single meta partnership. This asymmetry shows preference for growth narratives over value destruction. Here's what the system is actually rewarding. Sector rotation exposed thematic herding rather than fundamental analysis. Defense contractors exploded after Trump's defense budget proposal, a 66% increase that requires congressional approval. Memory stocks gained 28% on AI infrastructure optimism. Participants aren't evaluating individual securities. They're positioning in narratives they believe others will chase. The labor market data created genuine uncertainty that markets resolved through selective interpretation. Weak payroll growth was framed as dovish for Fed policy rather than recessionary for growth. Fed funds futures now price 2 quarter-point cuts despite the Fed's explicit guidance toward patience. This disconnect between market pricing and central bank signaling creates latent volatility that remains unpriced. The commodity complex signals divergent expectations. Gold advanced, while oil whipsawed on Venezuela supply announcements. The Treasury curve held steady at 4.18% despite weak payrolls, suggesting bond markets are less convinced of rate cuts than equity markets. Meanwhile, the VIX sits at 14.49, pricing minimal stress in a market trading at 22 times earnings. The semiconductor rally occurred without corresponding volume expansion, indicating low liquidity conditions where marginal flows generate outsized moves. This is momentum in its technical form, price action that attracts capital which validates the price action. Such cycles persist until they exhaust marginal buyers or encounter fundamental resistance. The disciplined response requires recognizing what this environment actually represents. Markets priced for perfection create asymmetric risk profiles where downside volatility exceeds upside potential. Current pricing assumes AI monetization accelerates, defense spending materializes, consumer demand remains resilient, and inflation moderates without recession. Each assumption is plausible. Their simultaneous realization is improbable. The Supreme Court's pending tariff ruling represents a known unknown that markets have chosen to ignore rather than price. When binary outcomes crystallize, repricing occurs rapidly regardless of direction. The systematic approach isn't predicting outcomes, but structuring exposure that survives either scenario. This confirms we remain in a momentum regime where participation is rewarded and caution is penalized. The regime will persist until it doesn't, and transitions are marked by volatility, expansion, and correlation breakdowns. The market's message is clear. Optimism dominates, valuations are extended, and the path of least resistance remains higher until proven otherwise. The exploitable insight here is understanding that elevated valuations reduce forward returns and increase downside risk when conditions change. Current conditions favor tactical flexibility over strategic rigidity. Positions sized for survival rather than optimization preserve capital for opportunities that emerge when consensus fractures. This is how markets function. Uncertainty is tolerated until it crystallizes, then repricing occurs rapidly. The systematic exploiter participates in momentum while maintaining awareness that all trends terminate, and the transition from trend to reversal is rarely gradual. If you value systematic analysis over emotional noise, subscribe for frameworks that exploit human predictability rather than chase market narratives. The complete Stoic exploiter methodology is available in the description. Download it to understand how psychological patterns create systematic opportunities in every market environment.